Tonight I'm going to talk to you about The Warren Buffett Way by Robert G. Hagstrom Jr. This is the book. That is the man. The Warren Buffett Way is fairly simple to explain, although you should read the book, but his investing strategy isn't that complex. Step 1, turn off the stock market. Step 2, don't worry about the economy. Step 3, buy a business, not a stock. Step 4, manage a portfolio of businesses. Now we turn to step 1, turn off the stock market. He says the stock market is manic depressive. Don't allow the stock market to dictate your actions. The stock market is not a preceptor. It exists to assist you with the mechanics of buying or selling shares of stocks. If you plan on owning shares in an outstanding business for a number of years, what happens in the market on a day-to-day basis is inconsequential. Step 2, don't worry about the economy. Stop worrying about inflation or disinflation. Give yourself a break. I suggest a digital detox. You can do that almost any time. No one has economic predictive powers any more than they have stock market predictive powers. Time is more wisely spent locating and owning a business that has the ability to profit in all economic environments than by renting a group of stocks that do well only if a guess about the economy happens to be correct. Key word, guess. Step 3, buy a business, not a stock. These are 12 tenets of the Warren Buffett way. Business tenets. Is the business simple and understandable? Does the business have a consistent operating history? Does the business have favorable long-term prospects? Is management rational? Is management candid with its shareholders? Does management resist the institutional imperative? What is the ROE? What are the company's owners' earnings? What are the profit margins? Has the company created at least $1 of market value for every dollar retained? What is the value of the business? Can the business be purchased at a significant discount to its value? All right, tenet number 1. Is the business simple and understandable? You can't make an intelligent guess about the future of your business unless you understand how it makes money. Investors need to be able to understand cash flow, labor issues, pricing flexibility, capital needs, revenue growth, and cost control. Does the business have a consistent operating history? You need to know whether the company has stood the test of time. You should be assured that your company has been in business long enough to demonstrate an ability over time to earn significant profits. Does the business have favorable long-term prospects? There are 2 types of companies, franchise businesses and commodity businesses. The best business to own is a franchise. The worst business to own is a commodity business. Buffett says a franchise possesses a great amount of economic goodwill that allows it to better withstand the effects of inflation. Commodity businesses have little or no economic goodwill. They sell products or services that can't withstand the effects of inflation. Is management rational? Buffett evaluates managers for their rationality, candor, and independent thinking. Managers should behave like business owners and be rational about how they reinvest cash earnings. If the company earns excess cash, the rational manager will only invest the excess cash in projects that produce earnings at rates higher than the cost of capital. If those rates are not available, the rational manager will return the money to shareholders by increasing dividends and buying back stock. Is management candid with shareholders? You can tell much about CEOs by the way they communicate to their shareholders. Good managers will disclose a company's performance, successes, and mistakes. Does management resist the institutional imperative? The institutional imperative is the mindless, lemming-like imitation of other managers, no matter how irrational their actions may be. Beware of managers who justify their actions based on the logic that if other companies are doing it, it must be all right. One measure of managers' competence is how well they are able to think for themselves and avoid herd mentality. Focus on return on equity, not earnings per share. Most investors judge a company's annual performance by earnings per share, watching to see if they set a record or make a big increase over the previous year. A truer measure of annual performance is return on equity, because it takes into account the company's ever-growing capital base. Companies can increase their return on equity by increasing their asset turnover, widening profit margins, or increasing financial leverage. Calculate owner earnings. Not all earnings are created equal. Companies with high fixed assets to profit will require a larger share of retained earnings to remain viable than companies with lower fixed assets to profits, because some of the earnings must be earmarked to maintain and upgrade those assets. Thus, accounting earnings need to be adjusted to reflect the cash generating ability. More accurate picture is generated by owner earnings. To determine owner earnings, add depreciation, depletion, and amortization charges to net income, and then subtract the capital expenditures your company needs to maintain its economic position and unit volume. Here is an example. You see that? Look for companies with high profit margins. High profit margins reflect not only a strong business, but management's spirit for controlling costs. Buffett loves managers who are cost conscious and abhors managers who allow costs to escalate. Every dollar that is spent unwisely deprives the owners of the business a dollar in profit. For every dollar retained, make sure the company has created at least $1 of market value. This is a financial test that will tell you about the strengths of the business and how well management has rationally allocated the company's resources. From a company's net income, subtract all dividends paid to shareholders. What is left is the company's retained earnings. Next, add the company's retained earnings over a 10-year period. Then find the difference between the company's current market value and its market value 10 years ago. What is the value of the business? The value of a business is determined by the estimated cash flows expected to occur over the life of the business, discounted at an appropriate interest rate. The cash flows of a business are the company's owner earnings. Can the business be purchased at a significant discount to its value? Once you determine what a business is valued at, next seek to purchase it only when its price is at a significant discount to its value. Only at this final step does Buffett look at the stock market price. Other than that, he doesn't care about stock prices. Step 4, manage a portfolio of businesses. Since you are now a business owner and not a renter of stocks, the composition of your portfolio will change because you aren't measuring your success solely by price change or comparing annual price change to a common stock benchmark. You have the liberty to select the best businesses available. There is no law that says you must include every major industry in your portfolio, nor do you have to include 20, 30, 40, or 50 stocks in your portfolio to achieve adequate diversification. Buffett believes that wide diversification is only required when investors do not understand what they are doing. To solve this problem, the know-nothing investor should use an index fund and dollar cost average purchases. There is nothing shameful about being an index investor. In conclusion, the driving force of Warren Buffett's investment strategy is the rational allocation of capital. Rationality, displaying rational thinking when making that choice, is the quality Buffett most admires. When Buffett purchases stocks, he is focusing on two variables: the price of the business and its value. Instead of focusing on the stock market, your time is better spent reading annual reports and business and industry articles. The best investment ideas come from doing your own homework. And this is the book. Warren Buffett's investment strategy might have changed since 1994 when this book was written. I mean, it's been a long time ago, 30 years. So I suggest reading an updated version of this book, or just doing things your own way. You don't have to listen to everything he says. Well, anyway, that is the video. Talk to you later. Bye.